back, and it's time for Ask Annex. Got a question? You head to our website, annexwealth.com. Sarah Kyle, Wealth Manager in the studio.
Hi, Danny.
And Matt Morzy, Investment Team Manager. Welcome to you.
Hey, Danny.
First question on Ask Annex. When ballparking retirement, is the 4% rule a good place to start? Sarah will give you that one, and can you explain it real quick?
Yeah, so the 4% rule is basically saying that you shouldn't take out more than 4% of your overall retirement accounts annually, and that should give you that 30-year long retirement path of not running out of money. But it's not a hard, fast rule. And so it can be used as a good starting point, but it's not a one-size-fits-all solution for everybody. So it's important to adopt that personalized spending rate based on your individual circumstances, market conditions, and risk tolerance when deciding your withdrawal strategy in retirement. And then you have to review it and update it on a regular basis.
But good starting point, but go to a pro.
Exactly.
Next on Ask Annex. Sorry for the dumb question, but could you explain what liquidity means?
I think it's a great question because liquidity gets used in a lot of different ways depending on the context. I generally define it as the ability to turn something into cash. So if you think your checking account, savings account at the bank, that's cash already. You can go to the bank, go ahead and get that. But if it's something other than that, you've got to sell it in order to create that cash. So whether it's a money market mutual fund, generally you could sell it in one day, but the proceeds become available the next. Stocks can get sold right away. For the most part, most stocks are extremely liquid, which means that you're going to be able to go ahead and sell it when you want to. There are small stocks that don't trade a lot that might be a little bit harder to do that. You might have a change in price in order to sell it and get out of it right away. Bonds don't trade all the time. So depending on the bond itself, you might have a big change in price in order to get out of it. Treasuries are generally considered to be the most liquid market that's out there. There's so many of them that's out there. You can get out of them right away with very little price change. But if it's a bond that hasn't traded in months, there's a chance that you might have to take less than what you thought. And then you kind of think past that, like your house or, in terms of real estate is, you got to find somebody to buy that from you at a price that's acceptable to you. And then you got to wait a while to actually get the cash from it. It's not like somebody's going to walk up with cash to buy your house. There's an entire process through closing and all of that to go through that. So they're very illiquid, especially when you're comparing it to things like bonds, stocks, money markets, and then cash.
Next up on Ask Annex, I've got a loss in my taxable holdings, and then he names a bond fund. I want to do some tax loss harvesting this year, but I also want to stay invested in a bond fund. Who determines if a different fund meets the, quote, substantially identical wash sale rule? Again, he names the fund, says it's actively managed. Would a passively managed bond index fund be considered substantially identical? What about parking the money in a short-term bond fund for the required 30 days?
Ultimately, it's going to be up to the IRS to determine if it's identical or not. In the situation that you're describing, where you're going from an actively managed fund to a passive index, that's going to be far enough away from each other because that active manager should be moving away from that index with the investments that they make. If not, why are you paying that fee when you can get an index for a lot less? So you're going to be okay there. When it comes to should you buy that index or should you look at a short-term bond fund for that 30 days from that wash sale window, it really depends on why you're owning that bond fund and kind of where you want exposure within that portfolio. In most situations, 30 days is probably not a problem to change that lineup up. But if you're targeting a specific duration within your portfolio, specific credit quality, if that's part of that ultimate pie or pizza that you're making in terms of what that allocation is, you're going to want to have something that's relatively similar to it. So again, if you're going from an active to a passive, you're at least going to have relative exposure in that same area. That's generally what we would do in that situation, but it might be different for you.
Next up on Ask Annex, I'm leaving a medium-sized company where I've got a 401k and joining a small company where I will have a simple IRA. My 401k balance is about $150,000. Is it a bad idea to keep my 401k at my old company?
No, it's not a bad idea. You just have to make sure you do your research. You have to compare the investment options that are available in each plan, compare the fees that the plans are charging, and really decide if you have time to adequately manage two accounts and make sure you are adequately diversified in your investment selections between the two accounts and really not overlapping. So just make sure you're looking at your overall portfolio and make sure that if you do keep those both open, that they are complementing each other and not overlapping. If you're investing in the same funds and two different plans, you might as well just consolidate into one plan.
Sarah Kyle, a wealth manager at Annex Wealth Management. Thank you.
You're welcome, Danny.
Matt Morzy, Investment Team Manager. Thanks to you.
Thank you.